Puzzled about tax planning for the new financial year? We take a look at the top tax-saving investment bets. Welcome to TOI Wallet Talks. To help you make a more informed decision about your tax-saving bets this year, we have with us Ektha Surana. She's tax expert at Clear, formerly ClearTax. Hi Ektha, welcome to the show.
Hi Smriti, thank you for having me here.
So Ektha, the aim of today's episode is basically to list out or summarize to our viewers what have been the major tax changes in popular investment instruments and what are the top popular options that they can look at investing in the beginning of this financial year, right? Firstly, we'll start by summarizing. If you could just tell me that in the last few years across instruments, what have been the major tax changes that I should be aware of?
Yeah. So before we begin dive into these investment option changes, there has been one big change, and that has been the new tax regime, right? So a lot of exemptions and deductions are not available under this new tax regime.
Yes.
So it's important for people to compare the final tax liability under both the regime, and then you have to decide which regime is best for you. Like if you're better off with the old regime, then it's important for you to choose the right tax saver options.
Yes.
Only then these investment options come into picture. Last few changes have been in ULIPs, insurance, in NPS, etc. Right? So in ULIPs, if your total aggregate premium amount exceeds 2.5 lakhs from various ULIPs, then it will become taxable. Earlier it was tax exempt. Likewise, in this budget 2023, there was a big change in insurance policies. So if your premium amount from all your insurance, which you take after 1st April 2023, those will become taxable from this financial year, that is financial year 23-24. But we've seen in the last few years, ELSS funds have also given returns up to 25%. So while investing in this scheme, you will have to choose between either a dividend plan or a growth option. So under the dividend option, dividends are paid to investor when they're announced by the fund, right? In the growth option, no dividends will be paid. The money will be reinvested back into the fund, and you will get the dividend amount in your aggregate final amount that you're receiving at the time of maturity.
Right.
So from 2021, what the government has done is they've made the dividends taxable in the hands of individuals. Earlier, it was taxable in the hands of companies. So these dividends will be taxed at the income rate which is applicable to you. Like say, if I fall in the 30% slab, then these dividends will be taxed in my hands at 30%. So this has been a change from 2020-21. And now, again, one more thing you'll have to consider is the capital gains tax. So earlier it was exempt, but from financial year 2017-18, what happened is gains in excess of rupees 1 lakh will now become taxable as your long-term capital gain under ELSS. Yeah. So one can say that ELSS will be an exempt category only if individual opts for a growth option while investing, and also while redeeming, he has to ensure that the capital gains does not exceed 1 lakh rupees.
Okay. What about other options? Has there been any changes there?
So coming to the next option, that is insurance, a lot has changed in insurance over the last 2-3 years. The premium that you pay is allowed as a deduction under section 80C. However, there are certain factors one must consider while buying life insurance, right? Because you cannot just buy life insurance for tax saving purpose. You'll have to make sure it aligns with your financial goals. Say you don't have any dependents for whom you have to leave behind some money in case of an emergency or in case of an unfortunate event, then there is no need for you to buy life insurance. You can go with a medical insurance if you, in case you need some money for your emergencies, medical emergencies it could be, right?
Right.
And there are 3 types of insurance plans, like ULIPs, that is unit-linked insurance plan. There is traditional insurance policy and term insurance. Term insurance policy is the cheapest among all life insurance products. This is because no money is paid at the maturity. And ULIPs and traditional insurance are a combination of both protection, like it will give you a life cover and also helps you with investment. So the premiums are also on the higher side. Right. So if you're planning to buy ULIPs or traditional life insurance policies, then you have to ensure that you don't end up paying taxes on maturity. So usually a ULIP comes with premium paying term of 15 to 20 years, and it has a lock-in period of 5 years. So once the lock-in period is completed, you can redeem the fund before the completion of premium paying term, right? But this won't happen in case of a term insurance policy. So how much you will get back will depend again on market performance.
Right.
And in case of traditional life insurance policy, it does not offer any liquidity during the policy term. Like in ULIPs, you can withdraw it after 5 years, right? This will not happen in your traditional insurance policy. You will be able to withdraw only in case of an emergency.
Right.
So the returns and also the returns from the traditional policies are very low, like around 5 to 6%. So the next is a very popular EPF or VPF, right? This becomes very mandatory for all the salary taxpayers. So this also gives you an exempt tax status. That means the amount that you're investing will give you a deduction under ATC, and the interest that you earn will also be tax exempt. But there is one change that has happened from financial year 2021. So if your contribution is more than 2.5 lakhs, then the interest that you're earning on the additional amount will become taxable. So only up to the 2.5 lakh limit, you will get tax exemption. And also the maturity proceeds are tax exempt. So this is a very good option for investors. But again, they'll have to see the lock-in period. It is locked in up to your retirement. So this may not be something that people would opt for. This becomes a dampener for investors. And then coming to the next investment option, that is PPF. This is also very popular. It has a lock-in period of around 15 years, fairly better than your EPF and NPS, which has lock-in periods up to retirement. And the returns are also very good here. It's about 7.1%. And these are sovereign guaranteed. That is, the government is backing these. So the risk is absolutely nil here.
Right.
So one can prefer these. And also premature withdrawal facility is available from 7th year. And you can also opt for a loan against this PPF amount. And this also, like EPF, enjoys an exempt tax status. That is, your deposit amount will give you a tax deduction. The interest is exempt, and also the maturity amount that you receive will be tax exempt. Just like the PPF, again, Sukanya Samriddhi Yojana is also exempt tax status. It has a slightly higher return of 7.6% and lock-in period of 21 years. So in case you have a girl child and you want to save up for that, then it's better you opt for the Sukanya Samriddhi Yojana.
So, Ektha, as an investor or as a person who's looking to save tax, what are the thumb rules that I should be looking at when I'm choosing an instrument for my investment?
Yeah, so like the thumb rule will be, there'll be various parameters on which you can decide. So one could be risk. How much risk are you willing to take? So let's say you're in your up to 40 years of age, like 20 to 40 years of age, then you have a slightly higher risk tolerance ability, right? So you can opt for an ELSS, which will give you higher returns. But if say you're in 40 to 60 years and if you're planning on a retirement corpus, then NPS, PPF, all of these are better options for you. But say you are above 60, then why don't you go for senior citizen savings scheme, or why don't you go for an FD or NSC? Then also comes lock-in period. So if you're investing now, you'll also have to consider that your money will be locked in for a significantly longer period of time. If you're investing in say NPS, but if it is ELSS, it has only 3-year maturity. So you may get the money back within 3 years. And in case you're investing in insurance, you may not get it until in case that an emergency arises. You will not be able to claim that insurance.
So these are the thumb rules there.
Yes.
The lock-in period and the risk appetite.
Right.
Okay. So Ektha, across risk profiles, irrespective of your age or other circumstances, if you were to list out for us the top 5 tax-saving investment options that are available out there in the market, given any recent changes that have come about, making them non-triple E or making them taxable at other ends. So can you just tell us which are the top 5 ones that one should definitely look at when at the beginning of a financial year?
Yeah. So if you would ask me personally, my first pick would be ELSS, because I'm in a position to take that risk and also I'm aiming for a higher return. And then again, depending on how much limit I have not exhausted, right? We have a limit of 1.5 lakhs under ATC. So one part I've allocated to ELSS. The remaining part, I will see how much is left with me in that 1.5 lakh bucket. And then based on that, I will go for NPS, because NPS gives you 3 tax saving options. One is under ATC and one is under ATCCD 1B and ATCCD 2, right? So under ATC, you will get up to 1.5 lakhs. And under ATCCD 1B, you will get up to 50,000 additional tax savings.
Yes.
And up to 10% of the employer's contribution will also be given, like the tax exemption will also be given on that. So, and this is also available under new regime. So people opting for new regime can also claim that employer's contribution deduction. So my second pick will be NPS. The third will be ULIPs, because the returns are very good. And also in NPS and ULIPs, you need to know that you can rebalance your portfolio. That is, you can allocate your asset depending on whether, if markets are performing well, then I will have a higher portion allocated towards equity and a lower portion towards gilt or corporate bonds. And my fourth pick will be a medical insurance for myself, because this is very important. Like, any emergencies may arise. I don't need a life insurance cover right now because I don't have any dependents. So I'm not going to go for a life insurance cover. My fifth pick will be PPF, because it has great returns and I can withdraw it like as and when, I want, and doesn't have a very big, long lock-in period. And also it enjoys the exempt status.